All right, well, let's get started. So thanks everybody for joining us. I'm sure we've all heard the saying, the only certainty is death and taxes. And today we're going to be talking about recent tax changes. We're really glad you're here. I'm Kelly Olczak, managing partner of Lindley and Company. We manage the finances for a handful of families in the area. We are a pretty neat group. We are 100% woman-owned, registered investment advisor, which means we are fiduciaries. We're located in the Bushnells Basin here in upstate New York. We are excited today to present this information to you. We're going to go through a lot of information, and it's taxes, so it can be complicated. This is going to be a recorded session, so after we are done, we will share the link with you to allow you to rewatch it if there's an area that you feel you want to dig into deeper. But again, if there's something you want to talk about personally, one-on-one, feel free to reach out to me. Joining us today, we've got Chaz Miller, who's our operations manager, and she's going to help us with the live chat so that if there are questions throughout that you might have, she's going to help us answer those questions. Also, my partner, Becky Gillette, who is our dedicated Chief Compliance Officer, is joining us. One thing we've learned over the years is that as a firm, we really enjoy educating people. We like to help our clients and our prospective clients become better informed investors. And I think this is one of those topics that comes up, but no one really knows where to start. So we're going to talk about a number of things, but I wanted to share with you some basics. So first of all, the tax rates and brackets are not changing this year, but I want you to know that tax rates and tax brackets are different. We're going to be discussing some of the rule changes that have occurred with the Secure Act that just passed in December, and also some additional taxes that affect high income earners. Then we're going to talk a little bit about managing strategies that can help you reduce your taxes on your tax bill. And of course, I'm here to create awareness. Everyone's situation is different. I am not providing tax advice. I have to say that because Becky's on the phone, but that's actually true. So let's talk a little bit about the difference between tax rates and tax bracket. Again, if you have questions, add them to the chat, and then Chaz will let me know you've got questions so that I can answer them as we move through this discussion. So this slide is interesting. It kind of shows you the different brackets. These are tax brackets. As I mentioned earlier, the brackets have not changed this year. And I want you to know that, you probably already know this, but I'm just going to be a little redundant, so forgive me. Your marginal tax bracket and your effective tax rate are different. So let me explain. I really like this slide because it does give you an idea of the two side by side. So here's an illustration of marginal tax rates versus effective or average tax rates. So here's a family. They're married. They've got 2 kids. They've got a combined income of 110,000. They face a top marginal tax rate of 22%. And let me see if my silly highlighter works. I'm trying. There we go. So you probably heard people say, well, I'm in the 22% tax bracket. That doesn't mean that all your income is taxed at the 22% amount. It's the way I want you to think about it is your last dollars are taxed at that marginal rate. So you'll see here, and again, in this illustration, the family in itself have an average tax rate of 6%. So let's walk through that. So an individual's average tax rate tends to be a much lower than their marginal. And here's what changes. The deductions, that reduces your income. In this example, the couple can claim the standard deduction for 2020. So let me rewind. I found this slide and added it to the slide deck because it was not easy to understand. The group that does these for me, puts these things together, it was like kind of chunky. So I'm using 2020 numbers, but the illustration is effective. So this is the 2020 tax year. This couple has a total of standard deductions of $24,000, which reduces their income. And that leaves them with $85,200 in taxable income. And that amount is the amount that's subject to federal income tax. The top marginal rate applies only to the portion of the taxable income that end up in that bracket. So that $4,950 is the last bucket of money that gets taxed at that 22%. So let's see, I'm looking at notes, folks, so because this is kind of complicated. So the $19,750 of the couple's taxable income is taxed at 10%. That's the first bucket. And the next $60,500 is taxed at 12%, and only the last $4,950 is taxed at 22%. So if you combine that and you average it out, before credits are taken, their tax liability is $10,324. Okay, now, credits and deductions. Credits reduce your taxes dollar for dollar. So taxpayers subtract their credits from their tax that they would otherwise owe to determine their final liability. And in this case, they have the child tax credit, which helps a lot. So for our example, this couple that has $110,000 of taxable income, their final tax liability is $6,324, which ends up being about 6%. So if this system of calculating income tax wasn't complicated enough, then we add in all these other kinds of taxes that high income earners are affected with, and then they get really complicated. So let's take a look at those. Are there any questions yet, Chaz?
No, none so far.
Okay, thank you.
Thank you.
So this whole presentation is focused on how to effectively manage your tax bill. So if you have investments that are not in IRAs or retirement accounts, you have maybe a brokerage account, capital gains does affect your investments that are non-IRA can get hit with capital gains. And the way you would look at this is, generally speaking, people think about capital gains applying mostly to stock, but they can apply to other kinds of investments like rental properties, non-stock investments. And there is a distinction between short-term capital gains, which are gains on assets that you have held for less than a year, and long-term capital gains. And the way I like to help clients remember this, long-term capital gains are gains on investments you've owned for more than a year and a day. When you talk about short-term capital gains, they are taxed very much like your ordinary income. While long-term capital gains can be as little as 0%, depending on your tax bracket, but as much as 20%. So we're going to talk about bracket management on this, okay? So there are two strategies that you can choose from in any given year. you either want to minimize the income you report to the government in order to reduce your tax bill, or in certain circumstances, and this is going to sound kind of weird, you want to accelerate your income into the year, especially if this year's what you think you're going to earn this year is going to be lower than next year. While most of us will probably, I'm assuming, because I'm a pessimist when it comes to planning, that we will face higher taxes in the future. But for right now, at least this year, we can expect our tax rates to be the same. So if you think about your income, if you think your income is going to be the same this year, most likely you want to minimize your tax bill for 2023. However, if your income will rise next year, you know, maybe you anticipate a sale of a major asset next year, or you think you're going to get a job that's going to pay you more, you might want to pull some of your income into this year. Here's an example. We have a client who has a choice to take a distribution from her inherited IRA this year, or she can wait till next year. She is still working through the end of this year, so she has earned income. And working with her tax preparer, we decided that it would be more tax efficient for her not to take her inherited IRA distribution this year, because next year she's not going to have earned income. And so that distribution, which she has to take, is probably going to be taxed at a lower amount. And that's what I mean about bracket management. And with the onset of all these new taxes, bracket management is going to become more and more important each year. So some years you might want to take more money in income and push in, and other years you might want to push it out if you think you're going to be in a lower earning year. The whole point of this is to make sure that you land in the lowest tax bracket as often as possible. So let's look at some other ways to try and accomplish this. Okay. So as we mentioned, I don't know. So I know two things. I don't know anybody who says they have too much money, and I don't know anybody who loves their tax bill. I think we all want to minimize our taxes. So here are a couple ideas. So how, you know, some years we might want to accelerate, which we just talked about. No matter what, you want to talk to your tax preparer before you start making these decisions. I don't know your tax situation if you're a client of mine, but I do work with our clients' tax preparers to figure out what's the best strategy. Okay. So pushing income into one year or another can get tricky, and that's why we want extra help. So let's talk more about the possibility of minimizing your tax bill. And you're probably going to get sick of me saying this, but these are general topics and everybody's situation is different. So I want to make sure that again, you probably already know that. Ways to reduce your income. First thing, super simple, absolutely positively, if you can, fully fund your qualified retirement accounts every year. This is the easiest way to minimize your tax. Some of our clients are like, well, my employer doesn't match the 401k, so I don't want to do it. Well, that's a valid point that they may not be matching, but if you can put, you know, $20,000 away, $30,000 away to reduce your taxes, you might want to consider that. So,
Hey, Cal, so sorry to interrupt you.
yep, no worries.
I just launched the poll regarding maximizing retirement.
Yeah, so if everybody could take just a minute and answer this little poll, that would help us a lot. Thanks, Chance.
You're welcome.
How are we doing?
Good. I am just going to give it another couple seconds before I end that. Thank you, everyone, for participating.
How many people helped us with that?
We have 80% participation. So
Thank
I'm
you.
just going to
It's
end
really.
that.
And what was the most, was there a majority?
Yeah, so
answer?
a majority are how are you maximizing your retirement? And a majority of folks are maximizing their contribution to the full limit.
Great, that's great. So a couple things about, thank you, Chaz. A couple things about fully funding your retirement accounts. Any distribution that comes out of your 401k, 403b, these are pre-tax accounts, of course, and your IRA. When you take distribution, those dollars are not, they are exempt from this thing called net investment income surtax, or NIIT. And we're going to talk a lot about that in the next slide. But if you are in a higher income tax bracket, and what that means is if you're single and you have earned income of 120, sorry, not single. If you're married filing separately and you have income of 125K, or if you're married filing jointly and you have income of 250K, you might be affected by this other tax, which we're going to talk about in a second. So if you can reduce your income by $30,000 in 2023, and maybe your spouse is also reducing his income by 30,000, that's really going to help long term. You can also do the same thing in simple accounts if you have a simple IRA through an employer, or if you are self-employed, you might have a SEP IRA. Similarly, this helps. Okay. Now, we mentioned the new tax reforms. In December of 2022, the Secure Act 2.0 was put in place. And prior to Secure Act 2.0, if you were 70 and a half and still working, you could not make contributions to a traditional IRA. That age cutoff has been eliminated. So we have a lot of clients that are CPAs and attorneys or small business owners, and they don't want to stop working. So if they have a traditional IRA they can contribute to, before they couldn't because they were too old. Now that's gone. Okay, moving forward. All right, so I absolutely hate complicated tax concepts. So I added this slide to the slide deck because this NIIT, the net investment income tax, I should say, is pervasive. And what it is, it applies at a rate of 3.8% to certain net investment income for individuals, estates, and trusts. And in general, it includes, but is not limited to, things like interest, dividends, capital gains, rental and royalty income, and non-qualified annuities. Please note, this is one of those taxes that pertain to high income earners. So that's the one that I was saying, if you're married filing separately, 125,000 in income, or married filing jointly 250K. The NIIT was part of the Affordable Care Act, and its official name is Unearned Income Medicare Contribution Tax. And it was intended to help keep Medicare sustainable. That's a big mouthful. Are there any questions on that?
No questions currently. Thank you.
Great. So now that we've talked about fully funding your retirement accounts, the next thing you can consider is tax sensitive assets. So what does that mean? These kind of investments would go in a non-IRA account, like a brokerage account, and they would be the type of investments that are like a tax-free municipal bond, electronically traded funds, also known as ETFs. Low turnover strategies. There are some money managers that build portfolios that on purpose do not trade a lot during the year, so you are not incurring capital gains. That's the underlying investment. Of course, there is definitely an old saying, don't let the tax tail wave the investment dog. What that means is making decisions about your investments should not start solely based on taxes. It's just good to know you should, if you are in a higher tax bracket, you might not want corporate bonds in your non-IRA, but maybe a municipal bond is better for your taxable investments. So you always want to invest tax efficiently, but they should never be, the primary driver of your investment strategy. Okay, managing gains and losses. So I'm sure everybody loved last year. It was so exciting on the downside. We really haven't had a bad year like we had last year since 2008, 2009. So these rules apply also to non-IRA, non-retirement accounts. So if you have a brokerage account, it's probably likely that you have some capital gains that you have not recognized. What does that mean? When you recognize capital gains, it means you sold something. And if you had a year like last year, we did a lot of tax loss harvesting to kind of put some hay in the barn. So it was especially a good year to leverage losses. I know that sounds weird, but if you can harvest losses, you're kind of putting some hay in the barn so that when you do have gains in the future, you might be able to offset those gains with the losses maybe we harvested last year. I like to call it making lemonade because last year was a really tough year. And so we have some capital gain losses that are carrying forward that will help our clients later. So how do losses help you additionally? You can also use your losses to offset income as much as $3,000 a year. And capital losses carry forward. So what that means is let's say you had $9,000 of losses, but you were only able to use $3,000 against your earned income this year, that's $6,000 carries forward. So the next year you might be able to reduce your income by another $3,000 and the following year $3,000. So that's what I mean by carry forward. Harvesting losses can also lower your exposure to that lovely net investment income tax, NIIT, that we spoke about earlier. If you are in a lower tax bracket this year, you may want to harvest some gains that you can offset with those losses so you avoid paying higher taxes in the future. Okay. This is not terribly technical, but I want to make sure that I'm not going too fast. Does anybody have any questions? Okay. So the importance of this technique is to manage your holding period. Goes back to what I was saying, the difference between short-term capital gains, which means you own something for less than a year, or long-term, which I always say a year and a day, just to be safe that we don't fall into that short-term side of things. But long-term gains can be taxed up to 23.8%, while short-term capital gains can be taxed as much as 43.4%, including that NIIT. That's a very big deal. And I don't want to be taxed 43.4% if I can avoid it. So managing that holding period is really, really important. Another technique that you can do to manage your capital gains is selling at the stock lot. Again, this is if you have a brokerage account and That's where this last bullet, highest in, first out. Basically, what that means is let's say you had 300 shares of a particular investment, and you've held this investment for, maybe 5, 6, 7 years, and you need to sell something. You could actually pick the group of positions that you bought a number of years ago that have the highest basis or the least amount of gain. So in other words, you're selling your most expensive shares, meaning the ones that don't have as much growth, and you're lowering your gains, therefore lowering your modified adjusted gross income and your NIIT. The LIFO, the LIFO, stands for last in, first out, and that would mean your most recent shares. Okay, so this is important because there are different kinds of accounts that you could have that you put investments into. So tax-free accounts would be like your Roth IRA. Tax deferred would be your 401k, 403b, traditional IRA, that sort of thing. And taxable would be that brokerage type of accounts. And I'm sure if you have an advisor, you've heard a lot about asset allocation. In this slide, we're talking about asset location. And so it kind of ties into that municipal bond, tax-free municipal bond. You want to keep those in your non-IRA, because if they're spitting off income that's tax-free, boy, I'd rather that than having to pay income tax. And so Carrie is asking about inherited IRA. Thank you, Carrie. This is a inherited IRA. It is also included in tax deferred. I apologize. I should have put that in there. So inherited IRA, pre-tax 401ks, pre-tax 403bs, and traditional IRAs are deferred. Okay, this is a really interesting topic, HSAs. So we're going to talk about HSAs right now, health savings account. So this rule applies to you if you have an employer-sponsored health insurance plan that is a high deductible. What's the difference between HSAs and FSAs? FSAs are the type of savings account you have to spend it all by the end of the year. Whereas HSAs are the kind that you can defer, you could make contributions into, and you don't have to spend them at the end of the year. The Wall Street Journal came out with an article a couple years ago, and they called HSA a shadow IRA. So I have 2 CPAs on our Zoom today, and feel free to chime in, please. But the 3 best tax benefits about HSAs. 1, all of your contributions are made in pre-tax dollars, which reduces your income. And those pre-tax contributions reduce your modified adjusted gross income. All the money you use to pay medical expenses is distributed from the account tax-free. And this is really cool. If you're 65, there are no penalties for withdrawing money for non-medical use. So it's more, all your earnings, they grow tax-free. When you take them out, they're tax-free. They grow deferred, tax deferred. And if you pass away, your HSA passes on to your beneficiaries. Those are not tax-free to your non-spouse beneficiary. But if it's your spouse you leave it to, it is tax-free to your spouse. The caveat is, again, you have to have a high deductible health insurance plan. And with that, at least a deductible of $3,850 if you're individual, or $7,750 for family, and a maximum out-of-pocket cost of $7,500 500 single, 15,000 family. The most important thing to remember is you will no longer be able to contribute to an HSA once you move into Medicare. So if you're somebody that's still working after 65 and covered by an employer plan, you will be able to continue to make contributions to your HSA. But the minute that you move into Medicare, you can no longer contribute to your HSA. It is very, it's a nice little savings vehicle, both for healthcare and for retirement. I kind of thought that was a neat idea. Okay, long-term care. So we all know, or hopefully know, long-term care is very expensive and long-term care premiums are deductible. So this chart's kind of neat. And again, you need to look at the kind of policy you have. It needs to be a qualified long-term care policy to be eligible for these deductions. But as you can see in this chart, the older you are, the more your premium is deductible. Okay, so that does reduce your taxable income. Okay. There is a new poll. If anybody could help us with that, that would be great. Thanks, Chaz. We're getting better at this, Chaz, knowing when to pop those out. Good
We
job.
are.
How are we doing?
We have 100% participation in that
Wow,
one.
that's
Thank
great.
you, everyone.
And what was the result?
So it's 20% yes, 20% not sure, and 60 say no, not yet.
Good.
Thank you.
It is important to know that now we don't sell insurance. We have partners that help us with this, but we used to. And the important thing to know is long-term care insurance is a very personal discussion, and you understanding how it can help your personal situation is very important. And on top of that, what I've found is if you're super young, it may not be appropriate for you to buy long-term care insurance. The sweet spot tends to be around 50, 55, where it starts to make sense because the policies are expensive. And they are very much like collision insurance for your car. You hope you never need to use it. There's no cash value in it. So if anybody ever has questions about long-term care, please let me know. I'd be very happy to answer any questions you have. So this next slide, Chaz, are there any questions?
No questions on
Okay,
that.
good. Great. Okay. So we're going to talk about trusts and estates here, but there are different kinds of trusts. So we're using very broad brushstrokes. Okay. In this example, we're going to talk about trusts that are taxed. These are irrevocable trusts. Okay. So trusts are taxed very much like people, like individuals, in that they are subject to that nasty NIIT tax again. Okay. They have a 20% capital gains rate and a 37% top tax rate. But the brackets are very different. Trusts get taxed at the highest rate at a very low amount. What that means is if your trust generates income of as much as $14,450 and you keep it in the trust, you're going to get taxed. That trust is going to get taxed at 37%. Why is it that way? The government wants you to distribute the income. So they're encouraging the trust to distribute the income. And trusts are built for different reasons. So again, this is one of those things that's very individual. I guess the question becomes, should the trust keep its earnings and pay the higher tax, or run the brackets, which means distribute more to beneficiaries who are in lower brackets to reduce that, top tax rate. And again, to answer this question, you need to run a tax projection for the trust, including a lot of variables that are really personal. So we can't let taxes wag that investment dog tail. But if you can distribute $20,000 in investment income to a beneficiary or a child that are in a lower tax bracket, it might make sense. So for instance, that $20,000 distributed to a child who's in the 20% tax bracket, that's a $4,000 tax rather than twice that. So I think it might make sense. This is a duplication of the prior slide because we're going to talk more about NIIT a little bit more in detail. But I found the slide deck helps the conversation a little bit. There are so many ways that taxes can be applied. So we're going to really talk about NIIT. All right, so to better explain NIIT and how to determine your potential exposure. So again, the Affordable Care Act implemented this tax, and it's a 3.8% surtax. Now, caveat, Tim Shortsleeve, Paul Gard are on the call with us today. Both are CPAs. And I do have a question because I could not figure out in my research the difference between the 3.8% tax rate and the 0.9, which I'm going to get to in a second, because they both apply to Medicare. So I'm going to work through the slides, and then Tim, or Paul, if you could help me out with the differentiation. If I don't do a good enough job, or if you have some feedback, I would really appreciate it. Okay. So the Affordable Care Act implemented the NIIT, which is that 3.8% surtax that applies to those dividends, capital gains, rental income, and modified adjusted gross income is calculated by taking your adjusted gross income and adding back certain things like IRA contributions. So as an example, for a couple who are filing jointly with a modified adjusted gross income greater than $250,000, and their capital gains and dividend tax rate is not 15%. It's 18.8% for those long-term capital gains. But for the short-term capital gains, it's not 20%, it's 23.8%. So that's why it's really important to figure out a way, if you can, to reduce that modified adjusted gross income. Okay, so what income is taxed? When we deal with complicated situations like this, I'm always going to be redundant. So NIIT does apply, as I mentioned before, interest, dividends, capital gains, rental income, non-qualified annuities. What does that mean? Sometimes an annuity can be part of an IRA, okay? And then passive business activities. New to the list with this tax reform is alimony, because alimony is no longer excluded from a payer's income. And again, capital gains can include investment securities that are sold, but it can include investment real estate income from a second home or the sale of such if it's been depreciated. NIIT does not tax wages, earnings from active business activity, Social Security, tax exempt interests like those municipal bonds we talked about, income from IRAs and Roths and other retirement plans like those 403B, 401Ks. And the upshot of this is you need to pay attention to what kind of income you're earning and understand how different types of income are taxed. That's pretty much why this presentation is, we put this together. So here is an example of Ben and Jane who have income of $260,000. Their modified adjusted gross income, or income when certain deductions are added back, like the IRA contributions or the 401k contributions are added back. So they had to add back $30,000 to their 250K. And that 3.8% Medicare tax surcharge is in effect. So they end up having to pay $1,140 in tax. So, Tim Shortsleeve, Paul Guard, this is where I need you. The Affordable Care Act also introduced a 0.9% surtax on wages, compensation, and self-employment income that affect many taxpayers. Both of these, like this is, when I did my homework, the 3.8% is a Medicare tax, but this one is called a Medicare hospital insurance tax. And that's where I was like, what's the difference? So Tim or Paul, if you could help me later with that, or if you can chime in now, that would be great. But it does apply additionally to that family. So here's the example. So John and Rachel have a combined income of $330,000. Individually, they're under the threshold, so their employers will not be required to increase their withholdings. However, they have about an $80,000 amount over that 250 threshold. And so with that 0.09% surcharge, they owe another $720. Okay. So Tim, thank you. I need to correct the slide. This applies to wages and self-employment income, not investment income. Thank you. I will clarify that. And that's the difference. Medicare hospitalization tax seems to be separate from other Medicare services such as doctor visit. So that's the Part A of Medicare. Thank you. That's from Earl Dunbar. You're so smart, Earl. Thank you. Earl, you're so funny. Earl just said, that's the first time you've ever called me smart. Not true. Okay, so now that we've talked about taxes that you're likely to see, what about all the deductions and exemptions that help to offset your income and hopefully reduce your tax bill? Okay, so standard deductions versus itemized deductions. As you probably have noticed, your taxable income and your total income earned are two different amounts. That's because the IRS allows you to deduct some of your income to reduce your tax bill. Two ways to do it: standard deductions or itemized deductions. And for those of us who live in New York State, we all know about SALT. We'll talk about that in a second. The standard deduction is set at an amount that you can deduct from your income amount. The itemized deduction route allows you to claim a variety of different deductions. Previously, we were able to deduct mortgage interest, property tax, state and local income, that's the SALT. And for many taxpayers, these total deductions tend to be greater than the standard deduction. So when the Tax Cuts and Job Act was put into play, that eliminated many of the itemized deductions and nearly doubled the standard deduction in an attempt to make it easier and more attractive to take that standard deduction. But under the new legislation, the deduction for all, this is SALT again, all state and local taxes cannot exceed $10,000 combined. And that included, of course, state and local income tax, property tax, real estate taxes. And now only the interest on the first $750,000 of a new mortgage can be deducted. also are gone, which drove me nuts. You can't take deductions on your home equity line of credit. So Chaz, thank you.
Yes, I just launched our third and final poll question.
Awesome. We are getting
And again,
great.
thank you everyone for participating. It's very useful for us.
I'm glad that we put those little XXs on the bottom slide. That was great, Chaz. Very good idea. How are we doing?
We are doing good. I'll just give it another couple of seconds. And yes, John says, can you add an all of the above?
Ooh,
Which is a
good
point.
feedback. Thank you. Very good feedback. Can you document that, Chaz? Because that's something I didn't think about.
Yeah.
So how are we doing?
Good. I will end that one. And this time I will hit share results.
Oh, we're learning. Nice.
Yeah, looks like the big one that people clicked was home mortgage interest.
It's 100% participation. Thank you guys so much. Okay. Make sure I didn't go too far. Okay, so we did that slide. Okay. So in addition to deductions previously discussed, now I've got the hiccup, sorry. There are some other deductions that are altered by the tax bill. The deduction for charitable contribution has been increased from 50% to 60%. As I mentioned earlier, interest from home equity. Oh gosh, of course I've got hiccups. Stop. Home equity loans no longer deductible. The above the line deduction for alimony payments is eliminated by the Tax Cuts and Job Act. However, existing agreements are grandfathered into the old rules. Don't panic. So if your agreement, your decree finalized before 2018, the end of 2018, you will also be grandfathered into the old rules. For agreements finalized after, alimony is no longer deductible. This is the other one. If you get hired and by a new employer and or any employer for that matter, and they move you, those deductions, those expenses used to be deducted. They're not anymore. There is, however, an exemption to the rule for active military members, which of course, because I think they move every 3 years, right? Another item eliminated under the Tax Cut and Jobs Act is the personal exemption. The personal exemption was the amount that the taxpayer could deduct for himself or herself and each of the dependents. In 2017, the personal deduction amount was $4,050. The increase of the standard deduction helps so they doubled the standard deduction, so that kind of helped out a little bit with that. So it is expected to return in 2025 when the child credit will go back to 1,000. So they increased the child credit to 2,000, but that might go back up in 2025. Case limitations. So you were able to deduct that itemization. So that's gone. So we're just about done here. So many of these things, there's so many moving parts in this, and with all the rate changes, tax changes, your personal situation may require some questions. So this checklist is something that we'll send to you, and we've got a couple handouts that you guys are going to get afterwards. So there are ways to save. That's sort of why we did this. And you should always talk to your tax planner to see how these apply to you. So year-end checklist. We'll also help you with this. And that's it, guys. I really appreciate you guys joining us. We're going to send out a feedback survey form, which would help us terrifically figuring out, where we're hitting the mark. If there are any topics that you guys want to know more about, would be great. It'd be great to get that feedback. Any questions at all? Oh, there's a question. You're welcome, Carrie. Don't get a sunburn, girlfriend. Thanks, everybody. Chaz, is there anything you want to follow up on?
No, but if there's anything we touched on that you want to really dive into, just call or shoot us an email so we can schedule a one-on-one appointment to go into more details for you.
Perfect. Thank you.
Yeah, thanks everyone for coming.
Gotcha. Have a good day, everyone.
Bye.